Question 1. The evaluation methodology shows that a long-term client of Vienna Insurance Group, who has expressed concerns about immediate liquidity needs, is requesting to surrender a policy that has significant surrender charges and potential tax implications if cashed out prematurely. The client is insistent on proceeding, stating they need the funds for a speculative investment opportunity. As a representative of Vienna Insurance Group, what is the most appropriate course of action? Option A. Proceed with the policy surrender as requested by the client, as their instructions are clear and they are an adult capable of making their own financial decisions. Option B. Advise the client that surrendering the policy is a bad idea and refuse to process the request, suggesting they reconsider their financial priorities. Option C. Immediately process the surrender to meet the client's urgent need for funds, focusing on the administrative aspects of the transaction. Option D. Fully explain the surrender charges, potential tax liabilities, and the risks associated with the speculative investment, advising the client that this action may not be in their best long-term financial interest, and offer to explore alternative liquidity solutions or financing options that do not involve surrendering the policy. The correct answer is D. Fully explain the surrender charges, potential tax liabilities, and the risks associated with the speculative investment, advising the client that this action may not be in their best long-term financial interest, and offer to explore alternative liquidity solutions or financing options that do not involve surrendering the policy. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term fiduciary duty owed to them by a Vienna Insurance Group representative. The representative must navigate the temptation to facilitate a transaction that benefits the client in the short term, but may expose them to significant future risks or penalties, potentially violating regulatory principles of suitability and client best interests. Careful judgment is required to balance client autonomy with the professional obligation to act with integrity and diligence. The correct approach involves prioritizing the client's understanding of the implications and ensuring the proposed action aligns with their overall financial well-being and risk tolerance, even if it means advising against the immediate transaction. This upholds the principle of acting in the client's best interest, a cornerstone of regulatory frameworks governing financial advisory services. It demonstrates a commitment to transparency, informed consent, and responsible financial stewardship, which are critical for maintaining client trust and adhering to professional ethical standards. An incorrect approach that proceeds with the transaction without thoroughly explaining the potential negative consequences or assessing the client's full understanding fails to meet the duty of care. This could lead to regulatory breaches related to mis-selling, inadequate advice, or failure to act in the client's best interest. Another incorrect approach, that of dismissing the client's request outright without exploring alternatives or understanding the underlying motivation, might be perceived as unhelpful or dismissive, potentially damaging the client relationship and failing to provide comprehensive financial guidance. A third incorrect approach, which involves pressuring the client to accept a different, potentially less suitable product to meet the representative's sales targets, directly violates ethical principles of integrity and conflicts of interest. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's stated needs and underlying motivations. This should be followed by a comprehensive assessment of the suitability of any proposed action, considering the client's financial situation, risk tolerance, and long-term objectives. Transparency regarding all potential benefits and drawbacks, including regulatory implications and future consequences, is paramount. If a proposed action appears detrimental or ill-advised, the professional must clearly articulate these concerns and explore alternative solutions that genuinely serve the client's best interests, documenting all discussions and decisions. Question 2. To address the challenge of a client engaging in a series of complex, high-value transactions that appear unusual given their stated business activities and risk profile, and which have been flagged by Vienna Insurance Group's internal monitoring systems, what is the most appropriate course of action for the compliance officer? Option A. Immediately dismiss the flagged transactions as a potential system error and take no further action, assuming the client's activities are legitimate. Option B. Inform the client directly that their transactions have been flagged as suspicious and inquire about the nature of their business to clarify the situation. Option C. File a suspicious activity report, SAR, with the relevant financial intelligence unit immediately without conducting any internal investigation or consulting with internal departments. Option D. Conduct a thorough internal investigation. Gather all relevant documentation. Consult with Vienna Insurance Group's legal and compliance departments. And if a reasonable suspicion of financial crime persists, file a suspicious activity report, SAR, with the relevant financial intelligence unit. The correct answer is D. Conduct a thorough internal investigation, gather all relevant documentation, consult with Vienna Insurance Group's legal and compliance departments, and if a reasonable suspicion of financial crime persists, file a suspicious activity report, SAR, with the relevant financial intelligence unit. Explanation. This scenario presents a professional challenge because it requires balancing client confidentiality with the potential need to report suspicious activity, all within the strict regulatory framework governing financial services. Vienna Insurance Group, like all regulated entities, operates under stringent guidelines designed to prevent financial crime and protect the integrity of the financial system. The dilemma lies in discerning when an observation crosses the threshold from a mere anomaly to a reportable suspicious transaction, without unduly burdening legitimate business or violating client privacy. Careful judgment is required to avoid both inaction that could facilitate illicit activities and overzealous reporting that could damage client relationships and operational efficiency. The correct approach involves a thorough internal investigation and assessment of the observed activity against Vienna Insurance Group's established anti-money laundering (AML) and counter-terrorist financing (CTF) policies and procedures. This includes gathering all relevant information, consulting with internal compliance and legal departments, and considering the client's profile and the nature of the transaction. If, after this diligent internal review, there remains a reasonable suspicion of money laundering or terrorist financing, then filing a suspicious activity report, SAR, with the relevant regulatory authority is mandated. This approach is ethically sound and legally compliant because it upholds the duty to report potential financial crime while respecting the principle of not making unsubstantiated accusations. It aligns with the regulatory expectation that firms will proactively identify and report suspicious activities, thereby contributing to the broader fight against financial crime. An incorrect approach would be to immediately dismiss the observation without any internal review, assuming it is a simple error or misunderstanding. This fails to meet the regulatory obligation to assess and report suspicious activities, potentially allowing illicit funds to be laundered or terrorist financing to occur. It demonstrates a lack of due diligence and a disregard for the firm's AML/CTF responsibilities. Another incorrect approach would be to report the activity to the authorities without conducting a proper internal investigation. This could lead to the filing of frivolous or unsubstantiated SARs, which constrain regulatory resources and potentially harm the reputation of the client and Vienna Insurance Group. It also risks breaching client confidentiality unnecessarily if the suspicion is ultimately unfounded. A further incorrect approach would be to discuss the suspicion with the client directly before reporting it to the authorities. This is known as tipping off and is a serious regulatory offense. It alerts the suspected individuals to the fact that their activities are being scrutinized, allowing them to evade detection and potentially destroy evidence. The professional reasoning process for similar situations should involve a structured approach. 1. Observe and document. Record all relevant details of the suspicious activity. 2. Internal review. Conduct a thorough internal investigation, gathering all necessary information and consulting with compliance and legal teams. 3. Risk assessment. Evaluate the observed activity against internal policies, client risk profiles, and regulatory guidance to determine if a reasonable suspicion exists. 4. Reporting decision. If suspicion remains, file a SAR in accordance with regulatory requirements. 5. Confidentiality. Maintain strict confidentiality throughout the process, especially avoiding any tipping off. Question 3. The review process indicates that a financial advisor at Vienna Insurance Group is preparing to present a new investment product to a prospective client. While the product has strong long-term growth potential, its recent performance has been below expectations due to market volatility. The advisor is concerned that highlighting the recent underperformance might deter the client from investing, potentially impacting their sales targets. The advisor is considering how to best present this information to the client. Option A. Present the product's historical performance data accurately, including the recent period of underperformance, while explaining the market conditions that contributed to it and reiterating the product's long-term strategy and suitability for the client's goals. Option B. Suggests that the client invest a larger sum to offset any potential short-term losses, implying that this strategy will guarantee a positive outcome despite the product's recent performance issues. Option C. Focus exclusively on the product's projected future returns and potential upside, omitting any mention of the recent period of underperformance to avoid discouraging the client. Option D. Downplay the recent underperformance by framing it as a minor, temporary fluctuation and emphasize that past performance is not indicative of future results, without providing context for the recent period. Correct answer is A. Present the product's historical performance data accurately, including the recent period of underperformance, while explaining the market conditions that contributed to it and reiterating the product's long-term strategy and suitability for the client's goals. Explanation. This scenario presents a professional challenge because it requires balancing the company's financial interests with the ethical obligation to provide accurate and transparent information to clients. Vienna Insurance Group, like any financial institution, operates under strict regulatory frameworks designed to protect consumers and ensure market integrity. Misrepresenting product performance, even if intended to secure a sale, erodes client trust and can lead to significant regulatory penalties and reputational damage. The core of the dilemma lies in the conflict between sales targets and the duty of care owed to clients. The correct approach involves prioritizing transparency and accuracy. This means presenting the product's performance data truthfully, acknowledging any limitations or past underperformance, and focusing on the product's long-term potential and suitability for the client's specific needs. This aligns with regulatory requirements for fair dealing and accurate product representation, as well as the ethical principles of honesty and integrity. By providing a balanced view, advisor upholds their professional responsibility and builds a foundation of trust with the client, which is crucial for long-term client relationships and the reputation of Vienna Insurance Group. An incorrect approach that involves downplaying or omitting negative performance data is ethically unsound and breaches regulatory obligations. Such actions can be construed as misleading or deceptive conduct, leading to potential investigations by regulatory bodies, fines, and disciplinary actions against the advisor and Vienna Insurance Group. Furthermore, it violates the fundamental ethical principle of acting in the client's best interest. Another incorrect approach, which is to solely focus on the potential upside without acknowledging risks or past performance, is also problematic. While highlighting benefits is part of sales, omitting crucial context about performance can lead to client dissatisfaction and a breach of fiduciary duty if applicable. This approach fails to provide a holistic and accurate picture, potentially leading to misinformed decisions by the client. Finally, an approach that involves pressuring the client to invest despite reservations about the product's performance, without addressing those concerns transparently, is unethical and potentially illegal. This prioritizes the sale over the client's well-being and can lead to significant harm to the client and severe consequences for Vienna Insurance Group. Professionals should adopt a decision-making framework that begins with understanding the client's needs and risk tolerance. This should be followed by a thorough and honest presentation of product information, including both potential benefits and risks, and a realistic assessment of past performance. Any concerns raised by the client must be addressed directly and transparently. This process ensures compliance with regulatory requirements and upholds the highest ethical standards, fostering trust and long-term client relationships. Question 4. What factors determine the ethical and regulatory appropriateness of recommending a specific investment-linked insurance product to a client of Vienna Insurance Group, considering the client's stated desire for rapid capital growth versus the product's inherent long-term investment horizon and associated risks? Option A. The availability of similar products from competitors that might offer faster, albeit potentially high-risk, growth. Option B. A thorough assessment of the client's financial situation, risk tolerance, investment objectives, and a clear explanation of the product's features, benefits, and risks, ensuring alignment with regulatory suitability requirements. Option C. The client's explicit verbal confirmation of understanding the product's long-term nature and risks, coupled with a documented internal note of the conversation. Option D. The potential commission earned by the Vienna Insurance Group representative on the sale of the product, provided the client expresses some interest. The correct answer is C. The client's explicit verbal confirmation of understanding the product's long-term nature and risks, coupled with a documented internal note of the conversation. Explanation. This scenario presents a professional challenge because it requires balancing client interests with the ethical obligations of an employee of Vienna Insurance Group. The core conflict lies in a potential misalignment between a client's perceived immediate benefit and the long-term suitability and regulatory compliance of a proposed product. Careful judgment is required to avoid misrepresenting products or pressuring clients into unsuitable arrangements, which could lead to regulatory breaches and reputational damage for Vienna Insurance Group. The correct approach involves prioritizing the client's best interests and adhering strictly to Vienna Insurance Group's internal policies and relevant regulatory guidelines. This means conducting a thorough needs analysis, explaining product features and limitations transparently, and ensuring the recommended product is a suitable fit for the client's financial situation, risk tolerance, and objectives. This approach is ethically sound and aligns with regulatory expectations for fair treatment of customers and responsible product distribution. An incorrect approach would be to prioritize securing the sale over the client's suitability. This could manifest as downplaying risks or exaggerating benefits to meet sales targets. Such actions would violate ethical principles of honesty and integrity, and potentially breach regulatory requirements concerning product suitability and consumer protection. Another incorrect approach would be to proceed with the sale without fully understanding the client's circumstances, relying on assumptions rather than a proper assessment. This demonstrates a lack of due diligence and a failure to uphold professional standards, exposing both the client and Vienna Insurance Group to undue risk. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's needs and financial profile. This should be followed by a thorough review of available products, assessing their suitability against the client's profile and all relevant regulatory requirements. Transparency and clear communication with the client about product features, benefits, risks, and costs are paramount. If a product is not a suitable fit, the professional must have the integrity to decline the sale or propose an alternative, rather than pushing an inappropriate solution. This framework ensures that client welfare and regulatory compliance are at the forefront of all advisory and sales activities. Question 5. The monitoring system demonstrates that a senior sales representative at Vienna Insurance Group has been consistently recommending a specific, higher commission investment product to a long-term client, even when the client's stated financial goals and risk tolerance appear to align better with a lower commission, more conservative option. The representative's personal sales performance metrics show a significant increase correlating with these recommendations. What is the most appropriate course of action for a junior colleague who observes this pattern? Option A. Report the observed pattern of recommendations and the associated performance metrics to the Vienna Insurance Group's compliance department. Option B. Ignore the situation, assuming the senior representative is acting within their professional judgment and adhering to company guidelines. Option C. Discuss the observations with other colleagues to gauge their opinions and gather more information before deciding on a course of action. Option D. Directly approach the senior sales representative and question their sales tactics and client suitability assessments. Correct answer is A. Report the observed pattern of recommendations and the associated performance metrics to the Vienna Insurance Group's compliance department. Explanation. This scenario presents a professional challenge because it requires an employee of Vienna Insurance Group to navigate a situation where a colleague's actions, while not overtly illegal, raise ethical concerns regarding potential conflicts of interest and the integrity of client relationships. The employee must balance loyalty to a colleague with their own professional obligations and the company's reputation. Careful judgment is required to determine the appropriate course of action without making unsubstantiated accusations or ignoring a potential breach of conduct. The correct approach involves discreetly reporting the observed behavior to the appropriate internal channel, such as compliance or a direct supervisor, without confronting the colleague directly. This is the best professional practice because it adheres to Vienna Insurance Group's internal policies and ethical guidelines, which typically mandate reporting mechanisms for suspected misconduct. It allows the company's designated authorities to investigate impartially and take appropriate action, thereby upholding regulatory compliance and maintaining client trust. This approach prioritizes due process and avoids potential reputational damage that could arise from an unmanaged internal issue or a premature, informal resolution. An incorrect approach would be to ignore the situation. This is professionally unacceptable as it tacitly condones potentially unethical behavior and could lead to a breach of regulatory requirements related to client protection and fair dealing. It also fails to uphold the employee's duty to act in the best interest of Vienna Insurance Group and its clients. Another incorrect approach would be to directly confront the colleague and demand an explanation or cessation of the behavior. This is professionally unacceptable because it bypasses established reporting procedures, could lead to an escalation of conflict, and may result in the destruction of evidence or the colleague's preemptive denial, hindering any subsequent investigation. It also places the employee in a position of judgment and enforcement that is not their designated role. A third incorrect approach would be to discuss the observed behavior with other colleagues. This is professionally unacceptable as it constitutes gossip and a breach of confidentiality, potentially damaging the reputation of the colleague in question and creating a toxic work environment. It also undermines the formal reporting process and could be seen as an attempt to garner support for a personal grievance rather than a genuine concern for compliance. The professional reasoning process for similar situations should involve 1. Identifying the potential ethical or regulatory concern. 2. Consulting internal company policies and codes of conduct. 3. Determining the appropriate reporting channel as outlined by the company. 4. Acting discreetly and objectively, focusing on facts rather than assumptions. 5. Avoiding direct confrontation or discussion with unauthorized parties. Question 6. Risk assessment procedures indicate that a prospective major client for Vienna Insurance Group has provided assurances regarding their financial probity and adherence to regulatory standards, but has been hesitant to provide detailed supporting documentation for their claims, citing proprietary concerns. The sales team is eager to finalize the deal due to its significant revenue potential. As a compliance officer, what is the most appropriate course of action? Option A. Proceed with the client engagement, accepting the client's assurances and the sales team's enthusiasm given the substantial revenue opportunity. Option B. Immediately report the situation to senior management for a decision, without conducting further independent investigation. Option C. Advise the sales team to offer a reduced service package to mitigate potential risks, without fully verifying the client's claims. Option D. Insist on a comprehensive due diligence process, including independent verification of the client's financial standing and regulatory compliance, before any agreement is finalized. The correct answer is A. Proceed with the client engagement, accepting the client's assurances and the sales team's enthusiasm, given the substantial revenue opportunity. Explanation. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to secure a significant new client, especially in a competitive market, can create a temptation to overlook or downplay potential risks. However, a responsible professional must prioritize adherence to regulatory frameworks and ethical principles over short-term gains. The correct approach involves a thorough and objective assessment of the potential client's financial stability and regulatory compliance history. This means not just accepting the client's assurances at face value, but conducting independent due diligence. This approach is ethically sound and aligns with regulatory expectations for risk management and anti-money laundering (AML) procedures, which mandate robust know-your-customer (KYC) processes. Vienna Insurance Group, like all regulated financial institutions, is expected to operate with integrity and to avoid engaging with entities that pose a significant risk of financial crime or regulatory breaches. By insisting on comprehensive due diligence, the employee upholds these principles and protects the company from potential reputational damage and legal penalties. An incorrect approach would be to proceed with the client engagement based solely on the client's assurances and the potential for immediate revenue. This fails to acknowledge the regulatory obligation to assess and mitigate risks associated with new business relationships. It also demonstrates a disregard for ethical conduct, as it prioritizes profit over responsible business practices. Such an approach could expose Vienna Insurance Group to significant risks, including financial penalties, reputational damage, and even criminal liability if the client is involved in illicit activities. Another incorrect approach would be to escalate the issue without attempting to gather objective information or propose a solution. While escalation is sometimes necessary, it should be a last resort after reasonable efforts to address the situation have been made. Simply passing the problem up the chain, without providing a clear assessment of the risks and potential mitigation strategies, can be seen as a failure to take professional responsibility. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the core issue and potential risks. 2. Consult relevant internal policies and external regulations. 3. Gather objective information and evidence to support an assessment. 4. Evaluate potential courses of action against ethical principles and regulatory requirements. 5. Document the decision-making process and the rationale behind the chosen course of action. 6. Communicate findings and recommendations clearly and professionally. Question 7. The efficiency study reveals that a third-party vendor can significantly reduce operational costs for Vienna Insurance Group by analyzing anonymized client data. However, the vendor's proposed data handling protocols raise concerns regarding the completeness of anonymization and the potential for re-identification, which could conflict with data protection regulations. What is the most appropriate course of action for Vienna Insurance Group? Option A. Proceed with the data sharing after obtaining a written assurance from the vendor that their anonymization process is compliant with all applicable regulations. Option B. Share the data with the vendor but instruct them to delete it immediately after the analysis, assuming this mitigates any long-term privacy risks. Option C. Immediately reject the vendor's proposal due to the potential for data re-identification, regardless of the cost savings. Option D. Initiate a comprehensive review of the vendor's data handling protocols by Vienna Insurance Group's legal and compliance departments, ensuring adherence to all relevant data protection laws and ethical guidelines before any data is shared. The correct answer is A. Proceed with the data sharing after obtaining a written assurance from the vendor that their anonymization process is compliant with all applicable regulations. Explanation. This scenario presents a professional challenge because it pits the potential for significant cost savings against the ethical obligation to maintain data integrity and client confidentiality, core tenets of responsible financial services operations. Vienna Insurance Group, like any reputable financial institution, is bound by strict regulations regarding data handling and client privacy. The pressure to implement cost-saving measures, while a legitimate business objective, must not override these fundamental ethical and legal duties. Careful judgment is required to balance operational efficiency with compliance and ethical conduct. The correct approach involves a thorough, documented review of the proposed data sharing mechanism by Vienna Insurance Group's legal and compliance departments. This ensures that any data transfer adheres strictly to the relevant regulatory framework governing data protection and client confidentiality within the specified jurisdiction. Specifically, it would involve verifying that the third-party vendor has robust security protocols, that client consent, where required, is obtained, and that the data shared is anonymized or pseudonymized to the greatest extent possible while still achieving the study's objectives. This approach prioritizes regulatory compliance and ethical data stewardship, safeguarding both the company and its clients from potential breaches and legal repercussions. An incorrect approach would be to proceed with the data sharing based solely on the vendor's assurances without independent verification. This fails to meet the regulatory requirement for due diligence and oversight. It also breaches the ethical duty of care owed to clients by potentially exposing their sensitive information without adequate safeguards. Another incorrect approach would be to dismiss the efficiency study's findings outright without proper investigation. While caution is warranted, a complete disregard for potential improvements, especially if they can be implemented ethically and legally, could be seen as a failure of management responsibility. Finally, attempting to circumvent data protection regulations by sharing data in a manner that is not fully compliant, even if it appears to achieve the efficiency goals, constitutes a serious regulatory and ethical violation. Professionals should employ a decision-making framework that begins with identifying the core ethical and regulatory principles at play. This involves understanding the specific laws and guidelines applicable to Vienna Insurance Group in its operating jurisdiction. Next, they should assess the potential risks and benefits of each proposed course of action, with a particular emphasis on compliance and ethical implications. Seeking advice from legal and compliance experts is crucial. Finally, the decision should be documented, and the chosen path should demonstrably align with the company's commitment to integrity, client trust, and regulatory adherence. Question 8. Compliance review shows that a significant potential strategic partner for Vienna Insurance Group has requested access to a substantial amount of client data to assess the viability of a joint venture. The partner has provided assurances that the data will be handled securely and confidentially, and has emphasized the urgency of the request to meet their internal timelines for decision-making. Option A. Proceed with a phased data sharing process, ensuring all data shared is anonymized and aggregated where possible, and immediately initiate a formal legal and compliance review to establish clear data handling protocols and obtain necessary consents before any further data is disclosed. Option B. Inform the potential partner that Vienna Insurance Group cannot share any client data due to strict confidentiality policies, and explore alternative ways to demonstrate value without data access. Option C. Share the requested client data immediately, relying on the partner's assurances of security and confidentiality to expedite the potential strategic partnership. Option D. Share only a limited subset of the data that is deemed least sensitive, with the understanding that more data can be provided if the initial sharing is satisfactory. The correct answer is A. Proceed with a phased data sharing process, ensuring all data shared is anonymized and aggregated where possible, and immediately initiate a formal legal and compliance review to establish clear data handling protocols and obtain necessary consents before any further data is disclosed. Explanation. This scenario presents a professional challenge because it involves a conflict between a business opportunity and potential regulatory noncompliance, specifically concerning data privacy and client confidentiality. The pressure to secure a new client, especially one as significant as a potential strategic partner for Vienna Insurance Group, can lead to overlooking or downplaying regulatory obligations. Careful judgment is required to balance business objectives with the paramount duty to adhere to all applicable laws and ethical standards. The correct approach involves prioritizing a thorough due diligence process that explicitly addresses data protection and confidentiality requirements before any commitment is made. This means engaging legal and compliance teams to review the proposed data sharing, ensuring all necessary consents are obtained, and that the data handling practices align with the Vienna Insurance Group's regulatory obligations and internal policies. This approach is ethically sound and legally compliant because it upholds client trust, protects sensitive information, and prevents potential breaches of data privacy laws, thereby safeguarding the reputation and financial stability of Vienna Insurance Group. An incorrect approach would be to proceed with the data sharing based on the client's assurances without independent verification. This fails to meet the regulatory standard for data protection, which mandates proactive measures to ensure compliance, not reliance on third-party assurances alone. Another incorrect approach would be to selectively share only non-sensitive data, as this still carries the risk of inadvertently disclosing confidential information and may not fully satisfy the client's needs or the spirit of data protection regulations. Finally, delaying the compliance review to expedite the business deal is a direct violation of regulatory principles that require compliance to be integrated into business processes, not treated as an afterthought. Professionals should employ a decision-making framework that begins with identifying all relevant regulatory requirements and ethical considerations. This should be followed by a risk assessment of the proposed action, evaluating potential legal, financial, and reputational consequences of non-compliance. The next step is to explore alternative solutions that achieve business objectives while remaining compliant. Finally, decisions should be made in consultation with relevant internal departments, such as legal and compliance, to ensure all perspectives and obligations are considered. Question 9. Compliance review shows that an employee of Vienna Insurance Group, while working on a confidential due diligence project for a potential acquisition, inadvertently learned of significant undisclosed financial distress at the target company. This information is not yet public. The employee has a personal investment portfolio and believes this information could significantly impact the stock price of the target company, which is publicly traded. What is the most appropriate course of action for the Vienna Insurance Group employee in this situation? Option A. Immediately report the potential conflict of interest and the material non-public information to the Vienna Insurance Group Compliance Department and await further instructions. Option B. Continue with the due diligence project as planned, assuming the information will be disclosed by the company in due course, and therefore no immediate action is required. Option C. Make a personal investment decision based on the acquired information before it becomes public, believing it is a prudent financial move. Option D. Discreetly share the information with a trusted financial advisor to get their opinion on how to best manage personal investments without directly acting on it. The correct answer is A. Immediately report the potential conflict of interest and the material non-public information to the Vienna Insurance Group Compliance Department and await further instructions. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves a potential conflict between a business opportunity and the ethical obligation to maintain client confidentiality and avoid conflicts of interest. The Vienna Insurance Group employee is privy to sensitive information about a potential acquisition target, which could be leveraged for personal gain or to benefit another party without proper disclosure or authorization. Navigating this requires a strong understanding of ethical principles and internal company policies designed to protect both the company and its clients. Correct approach analysis. The correct approach involves immediately disclosing the potential conflict of interest to the relevant compliance department or supervisor. This action aligns with the ethical duty of loyalty to Vienna Insurance Group and upholds the principles of transparency and integrity. By reporting the situation, the employee allows the company to assess the conflict, implement appropriate safeguards, and make informed decisions about proceeding with the business opportunity, thereby preventing any actual or perceived breach of confidentiality or insider trading regulations. This proactive disclosure is crucial for maintaining trust and adhering to regulatory frameworks governing financial services. Incorrect approaches analysis. Pursuing the investment without disclosure is ethically unsound and likely violates insider trading regulations and company policy. It constitutes a misuse of confidential information for personal benefit, creating a severe conflict of interest and potentially exposing Vienna Insurance Group to significant legal and reputational damage. Sharing the information with a friend, even with the intention of seeking advice, is also a breach of confidentiality. This action risks the information becoming further disseminated, increasing the likelihood of a regulatory violation and damaging the trust placed in the employee by Vienna Insurance Group and its clients. Ignoring the situation and hoping it resolves itself is a passive but equally problematic approach. It demonstrates a lack of professional responsibility and an unwillingness to address a clear ethical dilemma. This inaction could lead to the situation escalating, resulting in a breach of regulations and internal policies and ultimately harming the company. Professional reasoning. Professionals facing such dilemmas should follow a structured decision-making process. First, identify the ethical and regulatory obligations at play, including duties of confidentiality, loyalty, and avoidance of conflicts of interest. Second, consult internal company policies and procedures, particularly those related to conflicts of interest and the use of non-public information. Third, if uncertainty remains or a conflict is identified, immediately escalate the matter to the appropriate compliance or legal department for guidance. This ensures that decisions are made in accordance with regulatory requirements and ethical standards, protecting both the individual and the organization. Question 10. Compliance review shows that a Vienna Insurance Group employee responsible for a significant new business acquisition has a close personal relationship with the principal of the target company. The employee is aware of this relationship and believes it will not influence their professional judgment regarding the deal's terms and valuation. However, the employee has not disclosed this relationship to their manager or the compliance department. What is the most appropriate course of action for the employee? Option A. Discreetly inform the principal of the target company that they will be handling the acquisition and assure them that their personal relationship will not be a factor. Option B. Withdraw from the acquisition process without informing anyone of the specific reason for their withdrawal. Option C. Proceed with the acquisition process as planned, confident that their personal relationship will not impact their professional objectivity. Option D. Immediately disclose the personal relationship to their manager and the compliance department, and request guidance on how to proceed with the acquisition process. The correct answer is D. Immediately disclose the personal relationship to their manager and the compliance department, and request guidance on how to proceed with the acquisition process. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to secure a significant deal, coupled with the potential for personal gain, can cloud judgment. Navigating this requires a strong ethical compass and a clear understanding of Vienna Insurance Group's internal policies and relevant regulatory frameworks. The core conflict lies between expediency and integrity. Correct approach analysis. The correct approach involves immediately escalating the situation to the compliance department and seeking guidance. This is the most professionally sound action because it adheres to the principle of transparency and ensures that any potential conflicts of interest or ethical breaches are identified and addressed by the appropriate internal authority. Vienna Insurance Group, like all regulated financial institutions, operates under strict guidelines that mandate reporting of such situations. This approach prioritizes regulatory adherence and ethical conduct over the immediate prospect of a deal, safeguarding both the individual's professional standing and the company's reputation and legal standing. It aligns with the ethical duty to act with integrity and to avoid situations that could compromise professional judgment or lead to regulatory noncompliance. Incorrect approaches analysis. One incorrect approach is to proceed with the deal without disclosing the personal relationship. This is ethically flawed as it creates a clear conflict of interest. The individual's personal relationship with the potential client could unconsciously influence their decision-making, potentially leading to terms that are not in Vienna Insurance Group's best interest, or conversely, to terms that unfairly disadvantage the client. This also violates the principle of transparency and could be seen as an attempt to conceal a material fact, leading to potential regulatory sanctions and reputational damage for Vienna Insurance Group. Another incorrect approach is to attempt to manage the situation independently by downplaying the relationship's significance or by rationalizing that it won't affect professional judgment. This is a dangerous form of self-deception. Even if the intention is to remain impartial, the appearance of impropriety is sufficient to undermine trust and create regulatory risk. Furthermore, it bypasses the established internal controls designed to prevent and manage conflicts of interest, which are critical for maintaining the integrity of financial operations. A third incorrect approach is to withdraw from the deal without informing anyone about the reason. While this avoids direct involvement in a conflict, it fails to address the underlying issue and misses an opportunity for the compliance department to assess and manage potential risks. It also doesn't fulfill the professional obligation to report potential conflicts of interest, which is a key component of maintaining a robust compliance culture within Vienna Insurance Group. Professional reasoning. Professionals in the financial services industry, particularly within organizations like Vienna Insurance Group, must operate with a high degree of integrity and adhere strictly to ethical codes and regulatory requirements. When faced with a situation that presents a potential conflict of interest, the primary decision-making framework should be: 1. Identify the potential conflict. 2. Consult internal policies and relevant regulations. 3. Escalate the matter to the appropriate internal authority, e.g., compliance, legal, or management, for guidance and decision-making. 4. Act in accordance with the guidance received. This structured approach ensures that decisions are made objectively, ethically, and in compliance with all applicable rules, thereby protecting both the individual and the organization. Question 11. Stakeholder feedback indicates that a long-standing client of Vienna Insurance Group, who is also a significant shareholder, has requested a highly unusual and aggressive investment strategy for their substantial policy reserves. This strategy, while promising high short-term returns, carries a significant risk of capital depletion and may not align with the prudent investment guidelines mandated by the relevant regulatory framework governing Vienna Insurance Group's operations. The client is also implying that their continued investment in Vienna Insurance Group is contingent on this request being approved. Option A. Approve the client's requested investment strategy to maintain their business and shareholder support, and instruct the investment team to manage the risks as best as possible without explicitly highlighting the potential for capital depletion in internal reports. Option B. Politely decline the client's requested investment strategy, citing that it falls outside of Vienna Insurance Group's approved investment parameters and regulatory compliance requirements, and offer to explore alternative, compliant investment options that align with both their financial goals and the company's risk appetite. Option C. Agree to the client's requested investment strategy without further scrutiny, assuming their status as a significant shareholder and long-term client guarantees the validity of their financial judgment. Option D. Inform the client that their request cannot be accommodated and terminate their business relationship with Vienna Insurance Group immediately due to the perceived risk and potential for negative influence. The correct answer is B. Politely decline the client's requested investment strategy, citing that it falls outside of Vienna Insurance Group's approved investment parameters and regulatory compliance requirements, and offer to explore alternative, compliant investment options that align with both their financial goals and the company's risk appetite. Explanation: this scenario presents a professional challenge due to the inherent conflict between a client's immediate financial interests and the long-term solvency and ethical obligations of Vienna Insurance Group. The challenge lies in balancing the duty of care to the client with the fiduciary responsibility to the company and its policyholders, particularly when a proposed action, while potentially beneficial to the client in the short term, could expose Vienna Insurance Group to undue risk or violate regulatory principles. Careful judgment is required to navigate this ethical tightrope. The correct approach involves prioritizing Vienna Insurance Group's regulatory compliance and ethical standards over a client's potentially aggressive or inappropriate request. This means politely but firmly declining the request, explaining that it falls outside of acceptable risk parameters or regulatory guidelines, and offering alternative, compliant solutions. This approach upholds the company's integrity, protects its financial stability, and adheres to the principles of responsible insurance practice, which are paramount in maintaining public trust and regulatory approval. An incorrect approach of agreeing to the client's request without proper due diligence or consideration of regulatory implications would be a significant ethical and regulatory failure. This could lead to financial losses for Vienna Insurance Group, reputational damage, and potential penalties from regulatory bodies for engaging in practices that are not in line with solvency requirements or fair treatment of customers. Another incorrect approach of dismissing the client's concerns without offering any constructive alternatives would be a failure in customer service and could damage the client relationship, potentially leading to negative feedback and loss of business, while also failing to address the underlying issue in a professional manner. A third incorrect approach of agreeing to the request but attempting to conceal the associated risks from senior management or regulators would constitute a severe breach of trust and potentially illegal activity, leading to severe consequences for both the individual and the company. Professionals should employ a decision-making framework that begins with identifying the core ethical and regulatory principles at play. This involves understanding the company's code of conduct, relevant insurance laws and regulations, and the potential impact of any decision on all stakeholders. When faced with a conflict, the framework should prioritize adherence to these principles, even if it means disappointing a client in the short term. Seeking guidance from compliance departments or senior management is crucial when uncertainty exists. The process should involve clear communication, documentation of decisions, and a commitment to transparency and integrity. Question 12. Governance review demonstrates that a junior underwriter at Vienna Insurance Group has identified a pattern of minor, but consistent, miscalculations in premium adjustments on a portfolio of commercial policies. These miscalculations, while individually small, collectively represent a material overcharge to clients over the past year. The underwriter is aware that reporting this could negatively impact their team's performance metrics for the period, potentially affecting bonuses. What is the most appropriate course of action for the underwriter? Option A. Immediately report the identified pattern of miscalculations to their direct manager and the company's compliance department, providing all supporting documentation. Option B. Attempt to discreetly adjust future calculations to offset the overcharges without informing management, hoping the issue resolves itself over time. Option C. Discuss the issue with colleagues to gauge their opinion on whether it warrants reporting, delaying formal notification until a consensus is reached. Option D. Focus on meeting current performance targets and address the miscalculations only if they are explicitly raised by a client or auditor. The correct answer is A. Immediately report the identified pattern of miscalculations to their direct manager and the company's compliance department, providing all supporting documentation. Explanation. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to meet targets can create a conflict of interest, where an employee might be tempted to overlook or downplay potential issues to achieve short-term gains. Careful judgment is required to ensure that Vienna Insurance Group upholds its commitment to integrity and responsible business practices, even when faced with difficult decisions. The correct approach involves transparently reporting the identified discrepancies to senior management and the relevant compliance department, regardless of the potential impact on performance metrics. This upholds the principle of integrity, a cornerstone of ethical conduct in the financial services industry. Specifically, it aligns with the Vienna Insurance Group's internal code of conduct, which likely mandates reporting of all material issues, and with general regulatory expectations for robust internal controls and whistleblowing mechanisms. By proactively disclosing the information, the employee demonstrates accountability and allows the company to address the issue appropriately, thereby mitigating potential regulatory sanctions and reputational damage. An incorrect approach would be to ignore the discrepancies or attempt to rectify them without proper reporting. Ignoring the issues would be a direct violation of ethical duties and potentially regulatory requirements concerning accurate financial reporting and risk management. This could lead to significant penalties for Vienna Insurance Group and personal repercussions for the employee. Attempting to fix the issues internally without escalation might seem like a quick solution, but bypasses established governance procedures. This approach risks masking the problem rather than solving it, potentially leading to more severe consequences if the issue is discovered later by external auditors or regulators. It also undermines the company's internal control framework and the principle of transparency. Professionals in similar situations should employ a structured decision-making process. This involves first identifying the core ethical and regulatory principles at play. Then, they should assess the potential consequences of each possible course of action, considering both short-term and long-term impacts on the company, stakeholders, and their own professional standing. Finally, they should choose the option that best aligns with their organization's values, ethical codes, and applicable regulations, prioritizing transparency and accountability. Question 13. Compliance review shows that a potential new business partner for Vienna Insurance Group has a history of lax data security protocols, raising concerns about the protection of sensitive client information that would be shared. The proposed partnership offers significant market expansion opportunities. Option A. Immediately halt discussions with the potential partner due to the identified data security concerns and inform the compliance department of the potential risk. Option B. Negotiate a reduced profit share with the potential partner to compensate for the perceived data security risk and proceed with the partnership. Option C. Proceed with the partnership after obtaining assurances from the potential partner that they will improve their data security and document these assurances internally. Option D. Proceed with the partnership, assuming that the potential partner's assurances are sufficient and focus on the market expansion benefits. The correct answer is C. Proceed with the partnership after obtaining assurances from the potential partner that they will improve their data security and document these assurances internally. Explanation. This scenario presents a professional challenge because it involves a conflict between a business opportunity and potential regulatory noncompliance, specifically concerning data privacy and client confidentiality. The Vienna Insurance Group, like all financial institutions, operates under strict regulations designed to protect client information and ensure fair market practices. Navigating such situations requires a robust ethical framework and a thorough understanding of applicable laws. The correct approach involves prioritizing regulatory compliance and client interests above immediate business gains. This means conducting a thorough due diligence process, seeking legal counsel, and ensuring all data handling practices align with the Vienna Insurance Group's internal policies and external regulatory requirements, such as those pertaining to data protection and anti-money laundering. This approach upholds the company's integrity, protects its clients, and mitigates legal and reputational risks. An incorrect approach would be to proceed with the business opportunity without adequate investigation into the data handling practices of the potential partner. This could lead to breaches of data privacy laws, resulting in significant fines, legal action, and severe damage to the Vienna Insurance Group's reputation. Another incorrect approach would be to overlook the potential for conflicts of interest or market manipulation, which could also trigger regulatory scrutiny and penalties. Failing to consult with legal and compliance departments before committing to such a partnership is a critical ethical and regulatory failure. Professionals should employ a decision-making framework that begins with identifying potential ethical and regulatory issues. This is followed by gathering all relevant facts, consulting with internal compliance and legal teams, assessing the risks and benefits of each course of action, and finally, choosing the option that best aligns with regulatory requirements, ethical principles, and the long-term interests of the company and its clients. Question 14. Operational review demonstrates a significant anomaly in the client data management system at Vienna Insurance Group, suggesting a potential unauthorized access or misconfiguration that could expose sensitive policyholder information. As an employee who has identified this issue, what is the most appropriate immediate course of action? Option A. Immediately report the anomaly to the designated data protection officer or compliance department for investigation and remediation. Option B. Discuss the anomaly with a trusted colleague in a different department to get their opinion on how to proceed. Option C. Ignore the anomaly, assuming it is a minor technical glitch that will resolve itself over time. Option D. Attempt to rectify the data anomaly independently to avoid further complications and potential disciplinary action. The correct answer is A. Immediately report the anomaly to the designated data protection officer or compliance department for investigation and remediation. Explanation. This scenario presents a professional challenge because it involves a potential conflict between business objectives and ethical conduct, specifically concerning data privacy and client confidentiality within the Vienna Insurance Group. The challenge lies in balancing the need for operational efficiency and risk mitigation with the imperative to protect sensitive client information, as mandated by relevant regulatory frameworks. Careful judgment is required to navigate this situation without compromising the trust placed in the company by its clients and stakeholders. The correct approach involves immediately escalating the identified data anomaly to the designated data protection officer or compliance department. This is the most professionally sound course of action, because it adheres strictly to the principles of data privacy and regulatory compliance. By reporting the issue through the established channels, the employee ensures that the matter is handled by individuals with the expertise and authority to investigate, assess the risk, and implement appropriate remediation measures in accordance with data protection laws and internal policies of Vienna Insurance Group. This proactive and transparent reporting mechanism is crucial for maintaining regulatory adherence and safeguarding client data. An incorrect approach would be to attempt to resolve the data anomaly independently without proper authorization or expertise. This could lead to further data breaches, mishandling of sensitive information, or an incomplete understanding of the issue's scope, thereby violating data protection regulations and internal Vienna Insurance Group protocols. Another incorrect approach would be to ignore the anomaly, which constitutes a severe breach of professional responsibility and regulatory obligation, potentially exposing Vienna Insurance Group to significant legal and reputational damage. Finally, discussing the anomaly with colleagues not involved in data protection or compliance, even with good intentions, could inadvertently lead to unauthorized disclosure of sensitive information, violating confidentiality agreements and data privacy laws. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves understanding the relevant legal and internal policy frameworks, identifying potential risks and conflicts, and following established reporting procedures. When faced with a situation like this, the immediate steps should be to identify the nature of the issue, assess its potential impact, and then escalate it through the appropriate channels within Vienna Insurance Group, such as the compliance or data protection officer, ensuring all actions are documented. Question 15. Compliance review shows that a Vienna Insurance Group employee, while working on a confidential internal project related to a potential strategic acquisition, inadvertently learns of significant financial distress at the target company that is not publicly known. The employee has a personal investment portfolio and believes this information could significantly impact the stock price of the target company. The employee is considering whether to adjust their personal investments based on this non-public information. Option A. Continue with personal investment decisions as usual, considering the information as general market knowledge that does not require specific reporting. Option B. Discuss the non-public information with a close friend who also invests in the stock market, seeking their opinion on how to proceed. Option C. Make a personal investment decision to sell shares in the target company before the information becomes public, believing it is a prudent financial move. Option D. Immediately report the situation to the Vienna Insurance Group Compliance Department and refrain from any personal investment decisions related to the target company until instructed. The correct answer is D. Immediately report the situation to the Vienna Insurance Group Compliance Department and refrain from any personal investment decisions related to the target company until instructed. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves a potential conflict between a business opportunity and the ethical obligation to maintain client confidentiality and avoid conflicts of interest. The Vienna Insurance Group employee is privy to sensitive information about a potential acquisition target, which could be leveraged for personal gain or to benefit an external party. Navigating this requires a keen understanding of ethical boundaries and regulatory expectations regarding insider information and conflicts of interest. Correct approach analysis. The correct approach involves immediately disclosing the situation to the compliance department and refraining from any further action related to the potential acquisition until guidance is received. This aligns with the Vienna Insurance Group's ethical code and regulatory requirements that mandate reporting potential conflicts of interest and prohibiting the misuse of confidential information. By escalating the matter, the employee demonstrates integrity, upholds client trust, and allows the company to manage the situation appropriately, thereby preventing any regulatory breaches or reputational damage. Incorrect approaches analysis. Pursuing the investment opportunity without disclosure is ethically unsound and a direct violation of insider trading regulations and company policy. It constitutes a misuse of confidential information for personal gain, which can lead to severe legal penalties and disciplinary action. Sharing the information with a friend, even with the intention of seeking advice, is also a breach of confidentiality. This action exposes the sensitive information to unauthorized individuals, increasing the risk of leaks and potential insider trading by others, and violates the trust placed in the employee by Vienna Insurance Group and its clients. Ignoring the information and proceeding as if unaware is negligent and irresponsible. While it might seem like avoiding the problem, it fails to address the inherent conflict of interest and the potential for future misuse of the information. This passive approach does not absolve the employee of their ethical and regulatory obligations. Professional reasoning. Professionals facing such dilemmas should adopt a proactive and transparent approach. The decision-making framework involves 1. Recognizing the potential ethical or regulatory issue. 2. Consulting company policies and relevant regulations. 3. Escalating the matter to the appropriate internal authority, e.g., compliance, legal. 4. Refraining from any action that could be perceived as a conflict of interest or misuse of information until cleared by the relevant authority. 5. Documenting all communications and decisions. Question 16. Process analysis reveals that a long-standing client of Vienna Insurance Group, who has consistently expressed a conservative investment approach, is now requesting to invest a significant portion of their portfolio into a highly speculative and volatile new product that has recently been launched. The client states they heard about this product from a friend and are eager to capitalize on its perceived high growth potential. As the advisor, you have reviewed the product's prospectus and believe it carries a substantial risk of capital loss, far exceeding the client's stated risk tolerance. What is the most appropriate course of action for the Vienna Insurance Group advisor in this situation? Option A. Proceed with the client's requested investment, as the client is of sound mind and has explicitly requested the product, and it is their money to invest as they see fit. Option B. Inform the client that while the product is speculative, you will proceed with the investment as requested, but will not be able to offer any further advice or support regarding this specific investment due to its high-risk nature. Option C. Recommend the client seek independent financial advice before proceeding with the investment, without offering any specific guidance or alternatives yourself. Option D. Advise the client that the requested product is not suitable given their stated conservative investment profile and risk tolerance. Explain the specific risks associated with the product and propose alternative investment options that align with their financial goals and risk appetite. The correct answer is D. Advise the client that the requested product is not suitable given their stated conservative investment profile and risk tolerance. Explain the specific risks associated with the product and propose alternative investment options that align with their financial goals and risk appetite. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire for a specific investment product and the advisor's fiduciary duty to ensure the product aligns with the client's best interests and risk tolerance. Vienna Insurance Group, like all financial institutions, operates under strict regulatory frameworks designed to protect consumers and maintain market integrity. The challenge lies in navigating this conflict ethically and legally, ensuring transparency and suitability. The correct approach involves prioritizing the client's best interests above all else, even if it means deviating from the client's initial request. This aligns with the fundamental principles of client advisory, which mandate that recommendations must be suitable for the client's financial situation, investment objectives, and risk appetite. Regulatory bodies, such as those governing financial services in the relevant jurisdiction for Vienna Insurance Group, emphasize the importance of a thorough client needs assessment and the provision of advice that is in the client's best interest. This includes a duty to understand the client's knowledge and experience, financial circumstances, and investment objectives. Recommending a product that is demonstrably unsuitable, even if requested, would violate these core principles and potentially lead to regulatory sanctions and reputational damage. An incorrect approach would be to proceed with the client's request without adequate due diligence. This failure to assess suitability and prioritize the client's best interests constitutes a breach of regulatory requirements and ethical standards. It exposes the client to undue risk and could result in financial losses, leading to complaints and regulatory investigations. Another incorrect approach would be to dismiss the client's request outright without attempting to understand the underlying reasons or offering suitable alternatives. While the initial request may be ill-advised, a professional advisor should engage in a dialogue to educate the client and guide them towards more appropriate solutions, rather than simply refusing to engage. This lack of client engagement can be perceived as poor service and a failure to uphold professional responsibilities. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's profile. This involves gathering detailed information about their financial situation, investment goals, and risk tolerance. Following this, a thorough analysis of available products should be conducted to identify those that are genuinely suitable. If a client requests a product that appears unsuitable, the professional should engage in a transparent discussion, explaining the risks and potential downsides, and then propose alternative, more appropriate options. This process ensures that advice is not only compliant, but also ethically sound and client-centric. Question 17. Compliance review shows that a senior sales executive at Vienna Insurance Group is negotiating a significant new business contract with a potential client. During discussions, the client's representative casually mentions that their company is considering making a substantial investment in a private equity fund managed by a close family member of the senior sales executive. The executive stands to receive a substantial personal bonus upon the successful closing of this new business contract. What is the most appropriate course of action for the senior sales executive? Option A. Immediately escalate the situation to Vienna Insurance Group's compliance department and legal counsel for review and guidance. Option B. Dismiss the mention of the investment as a casual remark and continue with the negotiation, as it is not directly related to the insurance contract. Option C. Proceed with closing the deal, making a mental note to disclose the potential conflict of interest after the contract is signed. Option D. Seek informal advice from a trusted senior colleague within the sales department before deciding on the next steps. The correct answer is A. Immediately escalate the situation to Vienna Insurance Group's compliance department and legal counsel for review and guidance. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to secure a significant deal, coupled with the potential for a substantial personal bonus, can create a conflict of interest and cloud judgment. Navigating this requires a strong ethical compass and a clear understanding of Vienna Insurance Group's internal policies and relevant regulatory frameworks. The challenge lies in identifying and acting upon potential ethical breaches, even when they are not overtly illegal or explicitly forbidden by a specific rule, but rather fall into a gray area of professional conduct. Correct approach analysis. The correct approach involves immediately escalating the situation to the compliance department and legal counsel. This is the most appropriate professional response because it acknowledges the potential ethical concern without making a premature judgment. It ensures that the matter is reviewed by individuals with the expertise to assess the situation against Vienna Insurance Group's code of conduct, industry best practices, and any applicable regulations. This proactive escalation demonstrates a commitment to ethical conduct and regulatory adherence, protecting both the individual and the company from potential repercussions. It aligns with the principle of seeking guidance when faced with ambiguity or potential conflicts of interest, a cornerstone of responsible professional behavior. Incorrect approaches analysis. An approach that involves proceeding with the deal while making a mental note to disclose the potential conflict later is professionally unacceptable. This fails to address the immediate ethical concern and creates a risk of the conflict influencing decision-making during the negotiation process. It also bypasses the established channels for reporting and resolving ethical dilemmas, potentially leading to a breach of internal policies and regulatory expectations regarding transparency and conflict management. Another incorrect approach would be to dismiss the concern as a minor issue and proceed with the deal, assuming the client's intentions are purely business-related. This demonstrates a lack of due diligence and an underestimation of the importance of ethical considerations. It ignores the potential for even unintentional impropriety to have significant consequences for Vienna Insurance Group's reputation and regulatory standing. It also fails to uphold the professional responsibility to act with integrity and to avoid situations that could be perceived as compromising. Finally, an approach that involves seeking informal advice from a colleague without involving the compliance department is also professionally unsound. While collegial advice can be helpful, it does not substitute for formal review by designated compliance and legal personnel. Informal advice may not be fully informed of all relevant policies or regulatory nuances, and it does not create an official record of the concern being raised and addressed, leaving both the individual and the company exposed. Professional reasoning. Professionals facing such dilemmas should adopt a structured decision-making process. First, identify the potential ethical or regulatory issue and any conflicts of interest. Second, consult Vienna Insurance Group's code of conduct and relevant internal policies. Third, if ambiguity or a significant concern exists, escalate the matter to the appropriate internal departments, such as compliance or legal. Fourth, document all communications and actions taken. This systematic approach ensures that decisions are made with integrity, in compliance with regulations, and in the best interest of the company and its stakeholders. Question 18. Compliance review shows that a potential client for Vienna Insurance Group has provided documentation that appears to contain a minor but material discrepancy regarding their risk profile, which could impact the premium calculation and coverage terms. The sales team is eager to close the deal before the end of the quarter. What is the most appropriate course of action for the employee who identified this discrepancy? Option A. Attempt to resolve the discrepancy directly with the client without informing the compliance department to expedite the process. Option B. Ignore the discrepancy and proceed with the contract, hoping it will not be discovered during future audits. Option C. Immediately report the discrepancy to the Vienna Insurance Group Compliance Department and await their guidance before proceeding with the client. Option D. Proceed with the contract as is, assuming the discrepancy is minor and unlikely to cause significant issues, to meet the sales target. The correct answer is C. Immediately report the discrepancy to the Vienna Insurance Group Compliance Department and await their guidance before proceeding with the client. Explanation. This scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical obligations and regulatory compliance. The pressure to meet targets can create a conflict of interest, where an employee might be tempted to overlook or downplay potential issues to secure a deal. Careful judgment is required to ensure that all actions align with Vienna Insurance Group's commitment to integrity and the relevant regulatory framework. The correct approach involves prioritizing transparency and adherence to internal policies and external regulations, even if it means a potential delay or loss of immediate business. This demonstrates a commitment to ethical conduct and robust risk management, which are fundamental to maintaining trust with clients and regulators. Specifically, reporting the identified discrepancy to the relevant compliance department and seeking guidance ensures that Vienna Insurance Group operates within legal boundaries and upholds its ethical standards. This proactive measure prevents potential future penalties, reputational damage, and ensures the long-term sustainability of the business. An incorrect approach would be to proceed with the contract without disclosing the identified discrepancy. This failure to report a potential issue directly violates principles of honesty and integrity. It also exposes Vienna Insurance Group to significant regulatory risk, as non-disclosure of material information can lead to fines, sanctions, and loss of operating licenses. Another incorrect approach would be to attempt to resolve the discrepancy internally without involving the compliance department. This bypasses established control mechanisms designed to ensure regulatory adherence and ethical conduct, potentially leading to inconsistent or inadequate resolutions and further compliance breaches. Finally, ignoring the discrepancy and hoping it goes unnoticed is a clear abdication of professional responsibility and a direct contravention of the duty to act with due diligence and care. Professionals should approach such situations by first recognizing the potential conflict between business objectives and ethical/regulatory requirements. The decision-making framework should involve 1. Identifying the ethical and regulatory implications of the situation. 2. Consulting internal policies and procedures, particularly those related to compliance and reporting. 3. Escalating the issue to the appropriate internal stakeholders, such as the compliance department or legal counsel, for guidance and resolution. 4. Prioritizing long-term integrity and regulatory compliance over short-term gains. Question 19. Upon reviewing a long-standing client's portfolio at Vienna Insurance Group, you notice they are requesting a significant reallocation of their existing investments into a high-risk, speculative product that has recently gained media attention. The client explicitly states they want to get rich quick and are aware of the risks but are insistent on this specific product, mentioning they heard about it from a friend. You have concerns that this product does not align with their previously established moderate risk profile and long-term financial goals. Option A. Explain to the client that, while you understand their interest, the requested product does not align with their established risk profile and long-term financial goals, and propose alternative investments that are suitable and align with their objectives, while also educating them on the risks of speculative products. Option B. Inform the client that you cannot recommend such a product due to its speculative nature and advise them to seek advice elsewhere if they are determined to invest in it. Option C. Immediately process the client's request to reallocate their investments into the speculative product, as the client is insistent and has acknowledged the risks. Option D. Proceed with the reallocation, but include a comprehensive disclaimer in all documentation stating that the investment is highly speculative and may not be suitable for their profile. The correct answer is A. Explain to the client that while you understand their interest, the requested product does not align with their established risk profile and long-term financial goals, and propose alternative investments that are suitable and align with their objectives, while also educating them on the risks of speculative products. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the long-term fiduciary duty owed by an employee of Vienna Insurance Group. The employee must navigate potential pressure from a client while upholding the company's ethical standards and regulatory obligations. Careful judgment is required to balance client relationships with professional integrity. The correct approach involves prioritizing the client's best interests and adhering to regulatory guidelines regarding suitability and disclosure. This means thoroughly assessing the client's financial situation, risk tolerance, and objectives before recommending any product, even if the client expresses a strong preference for a specific, potentially unsuitable option. Vienna Insurance Group, like all regulated entities, is bound by principles of treating customers fairly and ensuring that advice and products are suitable. This approach aligns with the ethical imperative to act with integrity and in the client's best interest, preventing potential harm to the client and reputational damage to the company. An incorrect approach would be to immediately accede to the client's request without proper due diligence. This fails to uphold the duty of care and suitability requirements, potentially exposing the client to undue risk or products that do not meet their needs. Ethically, it prioritizes expediency over client welfare. Another incorrect approach would be to dismiss the client's request outright without attempting to understand their underlying motivations or exploring alternative suitable options. This could damage the client relationship and miss an opportunity to educate the client and find a mutually beneficial solution. Finally, suggesting a product that is clearly unsuitable, even with a disclaimer, is a failure of professional responsibility and regulatory compliance, as it implies a level of endorsement that is not justified by the client's circumstances. Professionals should employ a decision-making framework that begins with understanding the client's needs and objectives. This involves active listening and thorough questioning. Next, they must assess the suitability of any proposed product against these identified needs, considering risk, return, liquidity, and the client's overall financial picture. If a client expresses a strong preference for a particular product, the professional should explore the reasons behind this preference and then explain in clear and understandable terms whether the product is suitable and, if not, why, offering suitable alternatives. Transparency and honesty are paramount throughout this process. Question 20. System analysis indicates that a long-standing client of Vienna Insurance Group, known for their consistent premium payments, has recently made a series of unusual, large cash deposits into their account, which do not appear to align with their previously established financial profile or stated business activities. As a compliance officer at Vienna Insurance Group, what is the most appropriate course of action? Option A. Immediately contact the client to inquire about the source of the recent cash deposits and explain that their activity has raised concerns. Option B. Report the cash deposits to the relevant authorities immediately without conducting any further internal investigation or gathering additional information. Option C. Discreetly gather additional information internally regarding the client's transaction history and business dealings, and if suspicions are substantiated, follow Vienna Insurance Group's established procedures for reporting suspicious activity to the relevant authorities. Option D. Ignore the cash deposits as they are from a long-standing client, and the activity may be a temporary anomaly. The correct answer is A. Immediately contact the client to inquire about the source of the recent cash deposits and explain that their activity has raised concerns. Explanation. This scenario presents a professional challenge because it requires balancing client confidentiality with the potential need to report suspicious activity, a core ethical and regulatory duty for financial professionals. The Vienna Insurance Group, like all regulated entities, operates under strict guidelines to prevent financial crime. The challenge lies in discerning when suspicion crosses the threshold into a reportable event, avoiding both premature accusations and the failure to report genuine risks. Careful judgment is required to uphold trust while fulfilling legal obligations. The correct approach involves discreetly gathering further information to confirm or allay suspicions without alerting the client to the investigation. If suspicions persist and are substantiated by the gathered information, the next step is to follow Vienna Insurance Group's internal procedures for reporting suspicious activity to the relevant authorities. This approach is ethically sound and regulatorily compliant because it prioritizes due diligence and adheres to the principle of innocent until proven guilty, while simultaneously fulfilling the obligation to report potential financial crime, as mandated by regulatory frameworks governing insurance and financial services. This aligns with the duty of care owed to clients and the broader responsibility to maintain the integrity of the financial system. An incorrect approach would be to immediately confront the client with the suspicions. This breaches client confidentiality, can damage the business relationship unnecessarily, and may tip off the client, allowing them to conceal or move illicit funds, thereby hindering any potential investigation. Another incorrect approach is to ignore the suspicions altogether. This constitutes a failure to comply with regulatory obligations to report suspicious transactions, potentially exposing Vienna Insurance Group to significant penalties and reputational damage, and failing in the ethical duty to prevent financial crime. A third incorrect approach is to report the suspicion without conducting any further internal investigation or gathering additional information. While reporting is important, Doing so without a reasonable basis or further inquiry can lead to unnecessary investigations for the client and the authorities, and may not be sufficient to meet the threshold for a formal report if the initial suspicion is unfounded. Professionals should employ a decision-making framework that begins with identifying potential red flags. This should be followed by an internal assessment and information gathering phase, adhering strictly to company policy and regulatory guidelines. If the gathered information strengthens the suspicion to a point where it meets the reporting threshold, then the appropriate internal reporting channels should be activated. This process emphasizes a measured, evidence-based response that respects confidentiality while upholding regulatory and ethical duties.